Well, how's it going, friends and family? My name is Amos. Welcome to another episode of the Compounder's Corner. In this podcast, we're going to be going over the companies reporting their earnings this week, and we'll be talking about the stock market in general. Now, before we hop into the podcast, I wanted to let you all know that we have a promotional code for a free month of Stock Analysis Pro. It's the stock research website that I'm constantly using on this channel, and if you're interested, that link will be in the pinned comment. But more importantly, we recently found out Berkshire Hathaway went gung-ho in Delta Airlines. Yes, friends and family, an airline stock. While at the same time, they sold out of Amazon. Now, if you take a look at your screen right now, the Wall Street Journal, Berkshire Hathaway rekindles its tortured love affair with airlines, which is kind of funny. Because this dude right here, I look up to him and Charlie, they went on record by saying investing in airline stocks has been some of their worst mistakes ever. But time and time again, they keep investing into them. It's like he can't seem to quit his love affair with the airlines. Buffett told the Wall Street Journal on Monday he wasn't involved in Berkshire's new Delta position. So that shows us that Greg Abel is the one that pulled the trigger. But I think because Greg has been with Berkshire Hathaway for decades, he also shares a lot of this same perspectives and what he likes in the stock market as Warren Buffett. And that's why he decided to go in Delta. I'll be honest with you, I can't bless off on this decision. Now, obviously, who am I, right? My opinion is nothing. But the airline industry, the business operations, it's super cutthroat. And it's boom and bust. It goes in waves. There's peaks and valleys. It's not a slow and steady compounding machine, which is what I prefer. But then again, I can't really judge Berkshire Hathaway too harshly because I also do like boom and bust type of industries, such as the oil stocks. I like them. Like if you buy them as they're ramping up into the boom cycle, you're going to be a happy camper. But if you buy the oil stocks or airline stocks while they're at the very tip of the mountaintop of the boom cycle, and then 3 months later you're holding the bags as they go into their down cycle that lasts 3 years, you're going to be very upset. So when it comes to these cyclical industries and sectors, you have to know when to exit strategically. So you got to be a little more hands-on, but it doesn't necessarily mean that it's a bad thing. But I thought it was worth calling out that Warren Buffett, he's always preaching to us to only invest into high-quality compounders and everything else, but he also likes energy stocks and the airline stocks. Me personally, I wouldn't want to put a single penny into United, Delta, American, let alone Alaska Airlines. I'm not saying that they're bad. It's just as investments, as cash-producing assets with a robust economic moat, where regardless of if the times are good or bad, they're printing cash. They don't really fall into that category. So, yeah. And in case you missed it, some videos that were recently uploaded onto the channel, I uploaded part 2 in I guess we could say 1,000-part series as to why dividends are good stuff. And we debunked the myth of dividends are a tax drag. Now listen, I'm a dividend growth investor, a value investor, a contrarian investor, fill in the blank, whatever, which means I cherry pick the best attributes of all philosophies, right? I'm not a guy that's 100% gung-ho into income stocks. But at the same time, I feel like the hate for dividends is so forced. It's just an echo chamber of people copy and pasting whatever they heard on the internet. And then everyone seems to say, oh, dividends are useless. But that's just not the case. And that's why, I don't know, I just feel like I have a sense of duty to protect and defend dividend stocks because they're not as bad as people portray them to be. And then I also uploaded a video in which I shared exclusive Patreon research as to why I sold my food CPG stocks at a loss. And it is pretty eye-opening. I would highly recommend you check out that video. With that out of the way, on a high level, here are the biggest takeaways from this week's earnings. Number one, it's going to be a continuation of software stocks reporting, such as Salesforce on Wednesday. Beneath them is also Snowflake, UiPath, MongoDB. Dude, no matter how much I look into Mongo, I still don't understand what they do, which is kind of funny. There are SentinelOne and Okta, cybersecurity stocks, and there's also data center names like the chip designer Marvell reporting on Wednesday, Dell with their server racks, and then there's also HPQ. And I think people mistake this one as a growth play when it's really not. Because HP has two different stocks. HPE, yeah, that's the one that's going to be benefiting from the data center movement. But HPQ, they sell personal computers and physical printers. And don't even get me started on how much of a scam and a ripoff the modern physical printers are. Because the printers themselves, now it's only like 40, 50, 60 bucks. But how they get you is through the ink. There's like a specific QR code, kind of like, man, what's that coffee machine? Ah, that's right, Keurig, ticker symbol KDP, in which these ink cartridges, they only work if you buy it from HP. And the ink is like, it costs an arm and a leg. And not only that, there's a subscription model baked in where you can only print according to how much you pay per month. So instead of like how it used to be in the 90s, if you just buy a printer, you could just put any old ink cartridge in there. It's not like that anymore, right? You could just have unlimited things printing as long as you have sufficient ink. Nowadays, you have to pay for like 20 pages, 50 pages, 100 pages, and the ink, that's how they get you. So HP, yeah. And then we also have one of the food CPG stocks, Hormel, featured in that video that we talked about earlier. And then there's retail chains such as Dick's Sporting Goods, Best Buy, Burlington Stores, Kohl's, Costco. But of course, there's so much more. So we're going to be taking a closer look at each day of the week, and we'll be talking about the business operations as well in a deeper format. To kick things off on Monday, well, the stock market is going to be closed, and no offense, but these companies are kind of irrelevant, so happy Memorial Day. Now, as a veteran and as a guy that went to a military academy, I have a lot of friends and colleagues that have served in the military, and I don't know, I feel like most people associate Memorial Day as a 4-day weekend where you grill some hot dogs, you enjoy your time off. But for me, it's always been a kind of an awkward holiday. Because I think about said friends and people that I've crossed paths with in life that are no longer here. Whether they committed, like, I don't know if I can say that word, whether they went that route, or if they perished in battle. It's kind of like, it's a weird thing. I think a lot of people process grief in a different way. All that to say, just tell the people that are in your life, regardless if they're in uniform or not, that you love them while you still can. Because all I'm trying to say is sometimes there are some signs and symptoms, but other times you just really don't know who's thinking about doing a permanent solution to a temporary problem. You really don't know. And there's just going to be way too many conversations that you wish you would have said earlier. So it doesn't hurt to pick up your phone and to tell someone that you care about them and, just to say, hey, how's it going? But anyways, it's also graduation season. What is this, May 24th? So if you're graduating from high school, college, night school, trade school, whatever school or program, I'm proud of you. Good job and congratulations. Now let's move on to Tuesday. Tuesday, we've got AutoZone. I think I've already said way too much about how I feel about the used car market. On one hand, I'm very bullish because a lot of people are hanging on to their cars. Like in the past, I feel like it was customary to get rid of your vehicle when it hit like 100,000 miles just in time before all of the heavy hitting maintenance and repairs. Nowadays, I feel like more and more folks are hanging on to their cars as it hits 200, 300,000 miles on the odometer. Like that's normal. Reason being is that the used car market is absolutely broken. Car prices today, I don't want to go down that rabbit hole. It just drives me up a wall. So AutoZone, I'm bullish. But when it comes to their peer and rival in Advance Auto Parts, not so much, because the way that they handle their operations, their pricing, the integration of some of their acquisitions, Advance Auto Parts. So let's take a look at AutoZone. They're in the business of running a whole bunch of different physical storefronts where you can go in and buy the most random crap for your car, such as a new air filter and everything else, okay? Yeah, take a look at them. See, past 5 years, 133% into the green. Their financials, slow and steady up and to the right, exactly what you want to see. Take a look at their competition, Advance Auto Parts, ticker symbol AAP, exact opposite scenario. Yeah, this has been on a declining trend since 2022. Take a look at their stock performance, past 5 years, negative 70%. That's why you can't just look at these stocks as a ticker symbol. You really do got to take into account who the heck is driving the ship. Some people disagree with me, but I really do think that a very smart, strategic CEO that has very good optics is well worth the money. Because with Advance Auto Parts, I'm so sorry if you work for them, but everybody from the director level up, they are to blame as to why this stock is so bad. Because AutoZone is the complete opposite experience while they're doing the exact same thing. So, yeah. And then there's also Zscaler operating in the cybersecurity space. Pretty bullish about cybersecurity stocks. And then as we scroll down, we've approached the micro caps, which I don't really care about. So I think it's a perfect time to give some updates about the big move back to the United States. If you haven't been keeping up with the channel, yes, finally moving. I'm really happy. I can't stand living in Japan. I really can't. I think for the first 2 weeks, it was like a honeymoon, delighted about everything, but eventually the customs, the manners, the way of life here, it just rubs you the wrong way. After 4 years, I am so ready to get out. Okay? I do think that Japan is a wonderful place to visit, but if you're an American and the way you think is American, you will never, ever like this society. I'm just saying it as it is, okay? So the moving company, we finally figured out who to procure, the best rates and everything. They're picking up our stuff next week. I can't believe it. It's finally happening. I'm so excited. But at the same time, surprisingly, we didn't accumulate too much crap while living in Japan. And so the price to ship our stuff to the US, it's not as crazy as I thought it would be. I was really imagining a bigger bill, but this is where it gets a little frustrating and stressful because of the stuff the current administration has started in the Middle East. Fuel prices, I'm sure you've noticed at the gas station lately, it's through the roof. And so the plane tickets to fly back to the US, my goodness gracious, it's just one of those things where it sucks. And honestly, for a good 3 hours, I contemplated doing an options play to generate the 10 grand to buy our tickets, but I decided not to. Right? If I was a young single guy that only had the accountability is just for myself, I would do it. But the fact that we are a family and there's more, I can't be selfish is the point that I'm trying to get at. I have a baby daughter, wife. I can't be just recklessly gambling, right? I don't treat the stock market as a casino like some people do. I try to do the best that I can in investing in asymmetric stocks where the upside is a lot higher than the downside. I don't go near options for that reason. And that's why I sold United Health stock in order to fund the flight tickets. Again, I mean, I talked about it, I think now 5 times. I really didn't want to sell, but it was the perfect amount of capital, 10 grand, in order to finance the flight tickets. So it is what it is, and that's why investing in stocks is pretty good. And I had a, like a 38% total return on United Health, and it was the right time to do and to sell and to get out. Jumping on over to Wednesday, we got Marvell Technology. This is a company that I talked about on the Patreon, and I kept saying, guys, this is the one that we need to jump in. I think they're massively undervalued. Had you bought into it at any point in time of me posting that research when they were $54 a share, you would be a very happy camper because they're almost $200 a share. They're in the business of designing custom AI chips for the hyperscalers, mostly Meta and Amazon, because they don't want to continuously pay the NVIDIA tax. And that's why companies such as Marvell and Broadcom, they're killing it because they're benefiting from making chips that might not be as good as the latest and greatest from NVIDIA, but it's custom tailored to the needs of the customer. It does exactly what they request. And much like NVIDIA that we talked about last week, remember how we said that they were going to crush their earnings, but it's all going to be priced in, and consequently, I think NVIDIA is going to go on a sell-off. I don't like making predictions like that, but that's exactly how it played out. I think NVIDIA went up to like 238, and they finished out the week at like 210 or something like. Actually, hold on, I don't want to talk out of my butt. Yeah, 215, and I definitely think that NVIDIA is going to probably continue to go on the decline until they hit like 190 a share. Honestly, it's frustrating to see. I'm not an investor, but I'm frustrated for you if you're invested into them. But unlike NVIDIA, I think Marvell is going to pump while also posting phenomenal numbers. You take a look at 42% growth in their top line on an annualized basis. This is just a phenomenal thing to see. So, I mean, for me, I bought into them and sold out of them a while ago. They're not even on my radar. I wouldn't even contemplate jumping in at their current valuation. I think that ship has sailed. And then there's also Salesforce. This one I really like. I sold out of them for a fat profit last year. And believe me when I say that I had no idea. I sold out of them like right here at 265. I had no idea that the SaaS sell-off was going to happen. I mean, I wish I could sit here and lie to your face and say, oh, I knew it was going to happen. No, I just feel like even if no one is holding me accountable, I just like operating with integrity. And so I'll be honest and say I had no idea that the sell-off was going to happen, so I timed it perfectly. But anyways, they're in the business of operating the world's biggest customer relationship management platform. A lot of people have grievances against this company, but the grievances against the ancient software companies is a common theme. You talk about ServiceNow, people that actually use it, IT managers, they hate it. You talk about Adobe, the actual users, they hate it for the bloated software and their subscription business model. You talk about Salesforce, people hate it. You talk about SAP, people hate it. So I don't really care whether or not people hate it, because the point is, it's best in class, the biggest market share, and your company is not going to jump ship to something that's vibe coded. So anyways, with Salesforce, the KPIs that matter, obviously it's going to be the backlog. I mean, this is a company that's just as reliable as a compounder can be. But the fact that they're selling off the way they are, I mean, I don't want to be too harsh, or I guess, but I think it's stupid. Okay, so the KPIs that matter is going to be their backlog, but also their ability to monetize AI features such as Agentforce. From my understanding, in the past 2 earnings calls, they've been crushing it. So I think in the SaaS sell-off, Salesforce being in the tier 2 landscape, I think it's one of the better deals. And I'm so sorry, unlike Adobe. I'm going to say it again and again because everybody and their ex-wife likes to go on and on about Adobe being undervalued, whereas I really don't think so. I think the market is pricing Adobe accordingly. not for the next 3 months or 9 months, but for the next 5 years. They're baking it in and pricing it in that Adobe is going to lose to AI. Likewise, I said the same thing about Intuit. I said the same thing about Duolingo. I said the same thing about PayPal. And I should stop because I feel like with my unpopular opinions, people hate on me, click dislike, or never come back to the channel. But I'm just saying it honestly, like if you want to preserve your capital, don't go near these companies, but people take it the wrong way. And I'm sorry, but maybe it's because I care about you and you're a stranger. I don't want to see people lose their money by putting it into business operations where I personally think they're going to suffer. But obviously it doesn't matter because every popular YouTuber, popular finance guru, or that guy on Twitter, everyone raves on and on about Adobe, Duolingo, so it doesn't matter what I think, right? And then also on Wednesday, we have PDD Holdings. This one I guarantee none of you have heard about. Believe it or not, they're very important. It's the Chinese parent company of Temu. Now, if you don't know what Temu is, it's basically like Five Below, Dollar Store, Amazon, and they sell a bunch of crap that breaks within a week. Okay? So things like socks, things like gadgets, things like watches, MP3 players. And I'll be honest with you, Temu, I'm not that bullish about. Now, TikTok, I'm bullish about. The reason why I'm not bullish about Temu is I think there's a lot of conflict and disagreement with the US and China. Consequently, PDD, or I guess Temu, they're at the mercy of the tariffs and trade policy, right? I think if anyone other than the current administration was in office, I think this company would be crushing, right? But when you factor in the tariffs, I just don't see a path for them to be outperforming the S&P 500, at least in the next 2 years or so. But the thing is, their valuation is dirt cheap. Their forward PE to be at a 7.8 while executing these type of numbers, it's in Chinese dollars. Let's do it to US dollars. To be executing $63 billion in revenue, what's their market capitalization? 134. So I guess the price of sales is not too bad. But the forward PE to be a 7.8, I think it's stupid. However, I think Wall Street hedge funds, institutional investors, I think they're thinking along the same lines as me, where this is a company that's being held back right now by the tariff policies. Which, to be honest with you, I'm not an economist, okay? But I definitely think this whole tariff debacle has done more bad than good. Because I think one thing that I'm understanding is a lot of business operations depend on one another for the supply chain to be optimized. But the moment you start imposing 200, 400% tariffs, and then they're not going to sit there and take that, and they impose sanctions, restrictions, and 200% tariffs right back at us, it hurts everybody. And that's why when the whole tariff situation started, I wasn't a happy camper. I just knew that it was going to do more harm than good. And now we're starting to feel the ramifications and the implications. Not good. But anyways, Wednesday, we also have the Bank of Nova Scotia. To be honest with you, I would rather invest into the Canadian banks than the U.S. banks right now. Because the U.S. banks, they're all so overpriced. It's almost ridiculous. Like the Bank of Nova Scotia, their forward PE is a 13. If I pull up, I don't know, JP Morgan Chase, I think they're in the S tier. Well, I will eat my shorts. Their valuation is actually 13.8. But hold on, let me try something like Goldman Sachs. Well, I guess that's why I should be looking at the bank stocks more often. Because the last time I looked at them, it was like 6-7 months ago, and their valuation was like 29, 30 PE. But it looks like their valuations have come back down, but they're still at an all-time high. And I guess that's the point that I'm trying to get across. Well, I guess all else being equal, then, if they're all going to have a freaking teen number PE, I would rather go with the U.S. bank stocks. But operating with the framework of the U.S. bank stocks having a PE ratio of like a 29 or a 30, whereas the Canadian ones like TD, which is another really good one. Having a 16, then I would go with the Canadian. But if they're all going to be equal across the board, then I would rather go with the US ones. I'm so sorry. Because the last time that I really looked at the bank stocks, it was in November, right after my daughter was born. And then after I came to the conclusion that they were overvalued, I just deleted them from my watch list and I didn't really follow up. But anyways, there's also Snowflake reporting. There's Heiko. They make the little accessories and the parts, the avionics for aircraft. There is Dick's Sporting Goods. To be honest with you, surprisingly, if you take a look at their 5-year total return, 177%. So if you're not based here in the US, I say here like I'm in Japan, but as an American, I always forget. But they're in the business of selling sporting equipment. So if you need to buy a new golf club, football cleats, pickleball racket, whatever it is, you go in there, you try it on, and you buy it. I got it wrong with this one because I remember in 2019, I had the opportunity to invest into them when they were dipping beyond dips at like, $30 a share or something like that. And my conclusion, I said they didn't have an economic moat. And I thought that Amazon was going to eat their lunch. I got it wrong. Because that $35 would be $231 today. That CAGR is absolutely ridiculous. And I think it's because sporting equipment is really different from other accessories, apparel, and stuff that we buy. Because sporting equipment, you want to feel it in your hands. You want to see how that bat swings or how that golf club feels in the hands. And I feel like once you're already physically in the store, you might as well buy it from Dick's rather than Amazon. So hindsight is 2020. I definitely got it wrong with Dick's. So if you're invested into them, I don't blame you. I think it's out of the retail landscape, I think it's one of the more high quality ones. Another one that should fall into that exact same investing thesis should be Bath and Body Works. It's the place where your wife likes to go to buy heavily scented soaps, body wash, and everything else. Because you don't want to just gamble on getting some random Chinese-made body wash from Temu, right? You want to be able to feel it, smell it, touch it in person. Having said that, the complete opposite experience of Dick's Sporting Goods, and I think that's because their financials are not as stellar as Dick's Sporting Goods. But that's also because I think in 2021 or 2022, they had a divestiture and they got rid of Victoria's Secret, and that's why their top line declined. So this is not an accurate depiction of why their gross sales has been declining, and that's why we should look at the EPS, because the net income should theoretically improve, but also not good. So I think that's why they're struggling. Because the stock market, they usually reward you based on your financial performance. Not always. There's stocks like Tesla where they diverge from that. They just go to the moon based on hype that Elon Musk tweets. And that's why if you're invested into Tesla, again, I don't blame you. Me personally, I cannot invest into Tesla. But when we talk about SpaceX, that's an entirely different conversation. I would invest in SpaceX. Tesla, not so much. But up until this point, if you wanted to invest into Elon Musk, Tesla was your only publicly traded option. But now SpaceX is coming up, so yeah, you no longer have to invest into Tesla. I mean, Tesla, they're making that big pivot into making robotics, not just cars. Because I think they're realizing that the Chinese EV makers, they're gonna sweep the board. Meaning, Chinese EVs, fraction of the cost, better battery capacity, more features, literally at half the price tag of a Tesla. I think that's why Elon probably made the pivot into making robots that will take over entry-level minimum wage positions like flipping burgers or picking and packing in a distribution fulfillment center. Which is kind of scary, and I disagree with that because if AI and robots take all of our jobs, it literally makes zero economic and social sense because how are we, the consumers, going to have any money to contribute or to buy stuff, right? And that's why I feel like this visionary movement of robots and AI taking jobs, people are so short-sighted. Yes, it's going to pump your numbers for the next quarter or two or the next 5 years, but the long-term consequences for the society when everybody is out of a job, including lawyers, DoorDash, Uber drivers, and everyone else, who the heck is going to have any money to buy anything, let alone buy a home or buy health insurance? We'll be able to afford nothing. And that's why I'm not trying to be a doomsday kind of guy, but I definitely think guardrails need to be in place before these tech leaders try to replace everybody. I don't know if that's an unpopular opinion, but I don't know. I just feel like we should consider the humanity aspect, because if humans don't have jobs, the economy is going to sink. Because it doesn't matter if your car can drive itself and make all these deliveries if nobody has any money to order anything anymore, right? Am I crazy, or is this coherent? I don't know. There's also Manchester United. I don't care about them, okay? I'm a Tottenham Hotspurs fan. Believe it or not, this weekend we might get relegated. And to be honest with you, my emotional stakes in the club this year has just been... I think I already came to the conclusion in January that we were going to get relegated. I'm not trying to be negative, but the possibility of relegation was there, so whatever. I've just been more gung-ho supporting the Seattle Sounders in our MLS campaign, because I really do think that we can go for the Supporters' Shield. Well, that's neither here or there. But as we look at more so on... And I'm so freaking embarrassed. Earlier in the video, I don't know, it was a tongue twister. I couldn't pronounce it. So my wife put me on. I asked her, I was like, hey, am I pronouncing this right? She's like, no, it's ink cartridge. That's what I was trying to say. I feel so embarrassed. Someone come take my master's degree, please. I don't deserve it. I can't even pronounce basic words. Ink cartridge. I guess I was pronouncing it like cartilage or whatever, the one that's what your nose and your earlobes are comprised of, and your butthole, I guess. But jokes aside, I also reflected while talking to her. I don't want to come across as too cynical and negative. I just yet to eat anything, right? I'm going on 19 hours of fasting right now, so I'm a little hangry, which is a way of saying that when you're super hungry, you get a little irritated. The current administration, they did bless me, because I put a crap ton of money into the military stocks and they went to the moon. So I think most things in life, it's all about perspective. You give and you take. There's good and there's bad. Military stocks, I got it right. I really wish I would have put my capital into oil as well. I kept talking about oil being a primary beneficiary sector of all the conflicts happening, and I just didn't do it. I'm stupid. But anyways, moving on to Thursday. We've got Costco. Now, Costco, I think when people talk about, oh, dividends don't matter, dividends suck, dividends this or that, can we just please talk about Costco? This is the definition of a dividend compounder with cheese. Their 5-year total return, or I guess stock price appreciation, not baking in the dividends, is 170%. But I think if we do bake in the dividends, let me see if there's a way for me to do it. Comparison tool. Okay, so we'll Costco right there. And this one bakes in the dividends, 184%. So 15% of the total return is attributed towards the dividends. Compare that to, just out of curiosity's sake, right? If we compare it to the S&P 500, exact same time period of 5 years, S&P 500, 92%, you would have almost 2x your portfolio in past 5 years, whereas with Costco, almost 3xing. Costco, I really like. I fumbled the bag. I did a lot of research on them. I posted it on the Patreon, like, hey, I'm thinking about buying into them. I don't know what it is right here. I was like, I'm going to buy into them, and then I hesitated, and I didn't get to. I'm stupid. I should have bought into them. They are literally one of the best retail chains out there with a gigantic economic moat. Don't even talk to me about BJ's. BJ's, no, they're not on the same level. Sam's Club, on the other hand, listen, if you live in an area that has Sam's Club but no Costco, I don't think you're missing out. I think Sam's Club is just as good. So it speaks to volumes of how much Walmart has improved Sam's Club. Because even like 15 years ago, Costco hands down was the better warehouse club membership. But at this point, I feel like they're pretty much the same thing. You take a look at, I just want to show you their dividend profile, right? This is not accurate. It's not just 1 year of dividend growth. Because if I scroll down and show you what I'm looking at, every handful of years, you get a magical extra dividend. So in 2017, you got $7. $7 as an extra special dividend, alongside with their normal scheduled dividend payout. You see that? As I'm going like this, it's every 3 months, the cadence of getting a quarterly dividend payout, and then bam, a $10 special dividend. You do it again, and then bam, a special dividend of 15 freaking dollars. They are a dividend compounder with cheese. Costco, I'm not going to make that same mistake again. If there's a market-wide correction or if these guys get punished harshly, I am buying. I am not going to hesitate. I'm not going to think twice. I am buying Costco, which is really funny because I used to be invested into them in 2019, sold out of them for a fat profit in 2021. I really wish I would have held. I wish I would have held. I need to stop selling out of these beautiful compounders with cheese. Another business enterprise that does special dividends, just like Costco, is Progressive Corporation, S tier in the insurance landscape. I think they're overvalued right now. I know you're looking at this and you're probably calling me crazy, but I have their fair valuation at $190. So at $199, they're grossly overvalued. That's why I sold out of them for a profit, because I plan on buying back in when there's a bigger pullback on Progressive. But anyways, I digress. I wanted to show you their dividend profile. A 7% dividend yield, that's not accurate because I think this one bakes in the special dividend. But take a look at Progressive. They also, just like Costco, at the end of the year, they return their profits right back to the shareholders as a special dividend. This past year, their special dividend was $13.60 on top of their normal dividend payout of 10 cents per quarter. Another one that should have been a part of this conversation is Cracker Barrel. Oh yeah, remember earlier how I talked about I love investing at the cyclical stocks like oil? Another one that I really like investing into? Restaurants. Cracker Barrel, probably one of my better investments of all time. I bought into them in, I want to say like 2020 during that crash, like right here when they went all the way down to, I don't know, 65. I sold out of them like over here at 135. Happy camper. Cracker Barrel, their marketing strategy, their tactics with their core target customer base, atrocious. Everybody at this company, I'm being serious, at the executive level, they need to go. They need to leave. They need new leadership to drive this ship because they've been fumbling so badly for the past 3 years. If you're invested into Cracker Barrel, I truly do not see eye to eye with you. This is a company that cut their dividend in the past 2 years because their operations are really struggling right now. But anyways, prior to the dividend cuts, Cracker Barrel every year used to pay a special dividend around Christmas time of bam, just like that. Bam. So they would give you $1.20, and then bam, $5. $1.25, $1.25, and then bam, $4.30. And then they cut their dividend in 2021, and then they cut their dividend again in 2024. It's a dumpster fire of an operation. I wouldn't go near Cracker Barrel. If I were to consider the restaurant landscape right now, the only one, I mean, I told you guys, right? I disclosed it. I've been dollar cost averaging into McDonald's as they hover around $2.75, $2.80 a share. Best in class, real estate, conglomerate, beautiful franchise business model. I love them. I'll say it. I love them because their numbers are beautiful, but also they're super resilient. And when people want to say, oh, there's no more growth left, they have already opened up all the locations they can. What more can they penetrate? Think about it, buddy. They're in the franchise business model. Okay? Which means their operators are going to continuously pay their marketing fees, their loyalty fees, their kickback fees, and anything else. And so as they make more money per existing location, so will McDonald's corporate, right? So for me, McDonald's. Number 2 would be Texas Roadhouse. And then I would also venture on to talk about, hold on, what's another one? There's a third one. It's at the tip of my, not Chipotle, not Darden, Domino's. Yes, that would be number 3. And Domino's, to be honest with you, they're out on a dip of all dips right now. I'm thinking about jumping in. I'm truly thinking about jumping in. I just need to do a deeper inspection to figure out if it warrants buying. Because I don't know if I want to buy McDonald's and Domino's. All else being equal, I would rather go with McDonald's. Now, obviously, the public portfolio series, it lags behind the real-time transactions, right? First and foremost, the Patreon community, you guys find out everything as soon as I buy or sell. And then sometimes, number 2, on the Compounder's Corner, I tell you guys about my transactions like a week or 2 after the fact. And then number 3, in the public portfolio series, you guys find out a month, maybe 3 months after the fact. So that's kind of like the general order of information getting disclosed. And that's because my hands have been pretty full as a stay-at-home dad. I really wish I could tell the Patreon community on a Monday, like, hey, I just bought this stock, and then tell the YouTube community on that following Wednesday what exactly it was. But I'm making excuses. I'm sorry, guys. But anyways, let's jump on back over to talking about Thursday. So Costco, the KPI, keep in mind, is their growth in Asia. Because I think right now they tapped out. They pretty much cornered every market in North America. So right now, Japan, Korea, and China, that's their big growth drivers. I'm telling you right now, here in Japan, I had a Costco membership. Doesn't matter if you go on a Monday or a Saturday, it is so freaking crowded. The exact same situation as Korea. And I watched some videos of China's Costco's, just as crowded. So my whole thing is Costco, I think their growth Cinderella story in the US is pretty much done. But I think with Asia, it's just getting started. But anyways, yeah, so their KPI is their growth in Asia, but also their subscription membership renewal rate. So circling back to McDonald's, they currently have like 44,000 locations. The game plan right now is to have 50,000 locations by 2027, and they're also going gung-ho about Cosmic, which is the beverage play, their answer to Starbucks, Dutch Bros. And then number 3, they own the most expensive real estate around the world. I like investing in real estate, companies that own physical properties, because what they do is they rent it right back out to the franchisees, right? So when you think about that McDonald's in Paris, Hong Kong, Chicago, New York City, yeah, McDonald's owns it. Love McDonald's. But also on Thursday, we've got, let's see, we've got Dollar Tree. We've got Best Buy. Can we talk about Best Buy? Okay, so before I give you my opinion, I just want you to take a look at what's happening, okay? Past 5 years, 46% into the red, currently $61 a share. 2022, they did hit a high of $135 a share. Their top line has been pretty much stagnant for the past 10 years. 2017 was $39 billion. Now it's $41 billion. Pretty much flat, okay, for all case purposes. But as you jump on over to their dividend profile, a 6% dividend yield, 75% payout ratio, okay? So when it comes to Best Buy, I really don't want to offend people, but because I want to like them, right? Valuation, 9.5. I think when it comes to Warren Buffett, he would probably look at Best Buy and get really excited, start sweating. Because for a value investor, Best Buy hits all of the criteria. But for me, the conclusion is I think they're a value trap. You invest into Best Buy and you're going to lose money. I think their share price is going to continue to decline, but also I think it's a yield trap. You buy into them for their 6% dividend yield, and you're going to be losing money in a total return perspective. Best Buy, I would not go near them. I think if you're bullish about consumers buying electronics and all of that, especially with the in-store experience, Walmart. I'm telling you right now, Walmart or Costco. If you're not bullish about the experience of going in the stores and catering towards a boomer population that don't know how to open up their own email, well, it's hard to say. Because in the past, as a kid, I remember going to Radio Shack and Circuit City. They're no longer around. So Best Buy, they're literally catering towards an aging population that's technology deficient. Like they don't know how to use computers. And I guess they've carved out a pretty niche space for themselves. But I mean, do you really see that being a growth driver? I mean, we have kids these days at age 3 or 4 that know how to do more with their iPad tablet than their grandparents who are aged 82. I'm not kidding. I'm not exaggerating. But if you're bullish on electronics and you don't care about the in-store experience, it's better to go with Amazon. It truly is. Best Buy is a trap. I personally wouldn't want to go near them. And as we scroll down, did we already talk about Burlington stores? Let's talk about Burlington stores. So they're operating in a very niche retail space where they sell very high quality designer stuff from like 3, 5, 10 years ago. Because if you're Nike, if you're Under Armour, if you're Adidas, you can't just burn your merchandise from the past season, right? You need to offload, get rid of it, because you have warehouse overhead costs and you can't just keep them taking up shelf space because it has to be replaced with the next season's apparel and goods. So there comes Burlington. There comes Ross, there comes TJ Maxx and their procurement teams, and they buy those clothes by the pallet. They procure it at a fraction of the cost, and then they sell it right back to the consumers. So you'll be buying a jacket from Columbia or North Face in 2026 that was the hottest and the greatest in 2020. So in a nutshell, that's how it works. And I'm going to say this right now, Ross has just been absolutely crushing it. And they cater towards a lower income customer demographic, whereas TJ Maxx caters towards the higher affluent customer base. I say affluent as in it's a big difference. No, like Ross, I think their average customer has like a $55,000, $65,000 household income, whereas TJ Maxx is like 75 to 85. Burlington is probably slightly below Ross. They're probably catering towards the most blue-collar working family group. And so, having said that, Ross has been on a tear. 5 years, 90% into the green, just absolutely crushing it. And I actually have a deep dive video on Ross on the channel. So, taking a look at Burlington, I'm curious what their 5-year is. 0.5% in the green. So pretty much flat in 5 years, which is kind of crazy. But Ross has been crushing it because I think psychologically, right, people do want to wear designer brands, but they just, in today's climate and economy, nobody wants to pay designer brand prices. So I think that's why these off-price retailers are going to continue to do well. But I guess if you only consider Burlington from the end of 2023 to now, fantastic. But if you holistically consider them, probably not the greatest. But all else being equal, I would rather go with Ross than Burlington because of the dividend profile. Because as Burlington does their thing of going up and down, especially in the past 5 years, you would have nothing to show for it. You'd be pretty much flat on your investment because there was no dividends paid out during that duration. But with Ross, all else being equal, why is it never pulling up? Like if they ever go through a period of like, trying to find a period. Okay, so like if you invested into them in 2021 up until like 2023 and they're pretty much flat, at least in the meantime, you got paid a fat dividend that's growing at a rate of 10% year over year. And that's why for me, like that's one way that I do tiebreakers. If I'm interested in two different companies operating the exact same landscape, sometimes I yield or default to the dividend profile. Other times I yield to the upside, like if their fair value is $100 and this one's at 50 and the other one's at 70, I'd rather go with the $50 one because the upside would be 100%. There's multiple ways to do tiebreakers, but the dividend profile for me is a fun way to do it, but it's also a very coherent way to do it. Clicking back to go to the rest of Thursday. Okay, sorry, that took a while. We've also got Hormel. Guys, I'm so sorry about Hormel. I got it wrong. My initial investing thesis for them, they're in the business of selling protein, right? Beef jerky, salami, ham, Spam. So I was like, dude, this is going to be phenomenal. Comes to find out in 2025, those are all level 1, or what is it, like type 1 carcinogen foods. Foods that cause gut cancer, butthole cancer. I forgot what the kosher way of saying that is. The butthole cancer. Here, let me look that up. I'm so immature. It's called colorectal cancer. So by eating deli meats, processed meats, you're doomed. And the current administration has been pushing that message pretty hard to the point where I really do think it's going to affect their sales. So even though they operate in selling protein, because it's all highly processed, Hormel, I'm bearish on. I'm bearish on. And there's also PDD Holdings, which I don't know if I ever told. No, I did tell you guys. I visited the U.S. I want to say like 2 years ago, maybe a year ago. It actually ran into one of the family members of PDD. And it's a Chinese milk tea chain that is just on a roar. They're ripping. But, as I said, why I never invested into them, they do not have they have zero economic moat. There's literally 50 Chinese milk tea, boba tea, whatever beverage tea brands that are spreading like wildfire in China, Hong Kong, Singapore, and none of them have an economic moat. Consequently, am I surprised to see that their top line, after growing at 800%, 167%, is now only 4%? I'm not surprised. That's why I'm so glad I did not invest into them. If I want exposure to the high margin beverage space, I'd rather invest into McDonald's. I'm serious. McDonald's coffee, McDonald's soda, McDonald's drinks in terms of the Cosmic brand. That's my exposure and I'm happy. And I don't need to invest into PDD. Speaking of which, value investing wise, Celsius, I think they sell energy sparkling water. That would be one that would pique my curiosity and my interest, but they do not pay a dividend. And I do think they're going to sell off even further before they have a rebound. But that would be the only other drinks stock that I would consider besides McDonald's is Celsius. And scrolling down, we've got Asana. Speaking of which, Monday.com, they crushed their earnings. And I do think they had a small little pop. Let me see. Yeah, so in the past 1 month after posting earnings, they're up 16.5%. So I think Asana might see a similar trend because they're peers, right? Whereas on the other hand, Intuit and Adobe, they crushed their earnings and they got sold off beyond belief because in my opinion, I think they are peers. So in the software landscape, I think it's kind of helpful to look at what happens and how the market reacts to peers before you decide you want to jump into one of their rivals. Okay, so let's jump on over to Friday. There's 16 different companies. There's Ehang. They're in the business of selling, I want to say, drones that deliver people from rooftop to rooftop. It's Chinese-based, not interested. So I think because Friday, there's nothing too crazy. This past week, I'll just tell you 2 stocks that I did some research on. I did a personal deep dive, number 1, into Planet Fitness, ticker symbol PLNT. They're in the business of franchising gym operations. But it's not like your old school, like Gold's Gym for meatheads that do deadlifts, power cleans, and bench press. No. This is the type of place that caters towards people that are trying to lose weight, cardio bunnies. They have a lot of like treadmills, but it's not necessarily a place you want to go if you're interested in hypertrophy or bodybuilding, because their supply of free weights is not the best. Okay, can you tell that I used to be a bodybuilder? I was a bodybuilder from 2007 to 2011. Not anymore. Now I just do calisthenics. But anyways, I looked into them because after they posted their earnings, check this out. They were roughly like, $110 a share, and they dropped down to freaking $37 a share. So I was like, holy moly macaroni. Is this an opportunity? Is this a falling knife? And, well, maybe I should talk about Planet Fitness some more, right? Take a look at their numbers. Their top line is pretty darn good. I mean, obviously 2020 is a fluke year because gyms in certain states, due to law and mandates, they weren't allowed to be open to the public, so they lost a lot of money. But ever since 2021, they've been crushing. Okay, so numbers-wise, things look good, and they operate a franchise business model, just like McDonald's, just like hotels, asset light. I really like that. So there's a lot to like about Planet Fitness, especially their core target demographic of catering towards fatties that are just trying to lose weight for $10 a month. Because if you want to niche down and cater towards meatheads like me in 2011 or 2010, you're not going to make too much money because it's a very small percentage of the population. But when you think about how 40% of Americans are fat, yeah, there's a pretty big population base for you. Okay? A lot to like about them. And another thing is the franchisees that operate the locations, they do all of the heavy lifting. Okay? And they send kickback marketing fees to Planet Fitness corporate. They don't do any of the heavy lifting. None. But one cool thing about their business model is that every 5 to 7 years, it's in the contracts with the franchisees that they have to replace their equipment. Every single one of their treadmills, every single one of their cardio machines, they have to be replaced in order to keep up the image and I guess the lifestyle of Planet Fitness. And they can't just buy it from a Chinese company. They can't just source it from Amazon. They have to buy it from Planet Fitness corporate. And that's why if you take a look at their most recent quarter, it went up by 19% because they had their, I guess, once in a periodic sequence of those equipment replacements. And so after looking into their earnings and everything else, they're expecting for only a 1% growth for this fiscal year. They're expecting for some pain because for the past 90 days, they went gung-ho and towards... See, as a former strategy guy, it drives me up the wall like Cracker Barrel. Please listen up, Cracker Barrel. When you have a winning recipe and you're doing everything the right way in terms of who you are, your identity, and servicing the people that actually want you, and then all of a sudden you have some idiot with an MBA like me saying, hey, why don't we change directions? And Planet Fitness went really hard in the paint of trying to cater towards muscle meatheads. And as a result, they lost a sense of their identity in their core customer base. They didn't want to go there anymore. They were intimidated by seeing people with big muscles walking around. And so they admitted on the earnings call, like, dude, we shot ourselves in the foot. We're sorry. It's like, dude, if it's not broke, why fix it? Why try to improve something that doesn't really need to be improved? Like, I think their marketing plan of catering towards the fatties, brilliant. Why change it to cater towards idiots like me with muscles? Don't do that. Just like Cracker Barrel, their core target demographic is the MAGA crowd, is the baby boomers crowd, the old folks. And then some idiot had the brilliant idea one day of saying, hey, why don't we cater towards millennials and do vegan food, gluten-free? And no, when they started doing crap like that, my goodness, when I tell you their core customer base, very vocal, very angry, and they had some stupid idea to change their branding and their logo last year. Cracker Barrel is just so stupid. And so when people tell me that leadership, it really doesn't matter, I'm like, dude, it absolutely matters because you can't drive these decisions without the CEO blessing off on it. So Cracker Barrel and Planet Fitness, just not for me. And I decided that Planet Fitness, their fair value is $45 a share after doing my calculation and analysis. I could be wrong. So at $52, they're overvalued. Okay, so did some research on them, decided I don't like it. The next thing that I looked into, now this one, pay attention, okay? I don't think anybody, no one on the internet has talked about them. Angel Studios, ticker symbol ANGX. It's a penny stock, yes. Okay, it's a media company that produces Christian content like the hit series The Chosen that follows the Gospels and the Bible of Jesus' life. Absolutely crazy numbers. Just take a look at their gross sales, please. 200% year over year. Are you freaking kidding me? Absolutely bonkers. Their balance sheet is okay for a media company. It's not the greatest. But at least the trend is, I don't even know if there's a trend, but at least it's 38 million, okay? And what makes Angel Studios special is that they crowdfund money from over 2 million paying Patreon-like members to fund their productions and projects, which between you and me, that's absolutely crazy that there's 2 million people. It's kind of like Netflix, except they get to vote on which projects to greenlight. So it's really interesting premise. In fact, when you think about season 1 of The Chosen, they raised $10 million by crowdfunding, straight from the people. Which, when you think about it, it was a record at the time. And Angel Studios, man, they're on my radar. Because when I think about, I guess this is when they were still a SPAC during their IPO, around $10. They ballooned up to $50. That's why I don't buy IPOs. You really don't know what's going to happen. After they IPO'd at $50 or whatever, they dropped down to $2.84. But at $2.80, I'm not trying to insinuate anything. But the reason why I'm scared to jump in is if you take a look at their net income situation, right? Their bottom line, they are burning cash in order to keep the content rolling out. And to verify that as a proxy, we can take a look at the cash flow. You can see that they're free cash flow negative. So Angel Studios, I really like them, but I'm really scared about how they're not wise with their use of capital. And I think that's because they're a media company and they're not exactly a business operation. Hopefully they get some business folks on board to help them out. So I think Angel Studios, it's a prime target to be acquired by Netflix or Amazon. That's what I see as a best case scenario. Worst case scenario, I do think they're undervalued. For me, I think Angel Studios should at least be $5 a share based on my own numbers. So they're undervalued by quite a lot. Having said that, I think they could also go belly up. Being a penny stock, that's a risk. So Angel Studios, I'm going to keep watching them because if they get to a valuation that makes no sense, I might jump in because I think their gross sales, it shows us that they have a lot of potential. I think they kind of remind me of Serve Robotics. Also a ton of potential in their gross sales, but their bottom line, just like Angel Studios, they're burning cash to stay alive. But I do feel bullish about sidewalk delivery robots. I do feel genuinely bad for the people that are going to lose jobs, DoorDash, Uber delivery because of the sidewalk delivery. But I also feel really bullish about Angel Studios because I think we're seeing a renaissance of people earning and craving Christian content. So they are operating in a very niche, underserved market. That's why I'm bullish about it. My only concern is they're not strategic with their capital utilization. So, yeah. Other than that, before I get out of here, take care of yourself this week, please. And setting the 5 love languages aside for a moment, consideration and compassion are some of the greatest forms of love you can give to another person, your coworker, your neighbor, your family member, your whatever. So just please keep that in mind when you feel like being a jerk on Tuesday or Thursday, okay? Having said that, I love you guys. Don't forget, there's a promo for the Stock Analysis Pro. You get a free month, no strings attached. Good luck in the stock market, and I will talk to you guys really soon. See ya!